$100. That's it. That's all it took for one guy to start investing in 1980. And that single $100, left alone in an index fund, would be worth over $11,000 today. And yet, surveys show that nearly 57% of Americans have less than $1,000 invested. Not because they don't want to invest, because they think they can't. They think you need thousands of dollars, a financial advisor, and some kind of secret knowledge just to get started. You don't. And in the next few minutes, I'm going to prove it. Here's what we're going to cover. First, why waiting is the most expensive mistake you can make. Then, exactly where to put your first $100, with specific platforms, account types, and investment options broken down in plain English. No jargon, no fluff. By the end of this, you'll know more about beginner investing than most adults who have been working for decades. I've spent years researching personal finance, and the number one thing I hear from people who finally started investing is this: they wish they had done it sooner. So let's not waste another second. Let's talk about why starting right now, even with just $100, beats waiting until you have more money. This comes down to one concept: compound interest. And I know you've probably heard that term before, but let me give it to you in a way that actually hits. If you invest $100 a month starting at age 25, and you earn an average of 8% per year, which is a historically reasonable return for a diversified stock portfolio, you'll have around $350,000 by the time you're 65. Now here's where it gets painful. If you wait just 10 years and start at 35 instead, you end up with about $150,000. You waited 10 years. You contributed less money overall, and you ended up with $200,000 less. That's the cost of waiting. Every single month you sit on the sidelines is a month of compounding you're giving up forever. And the beautiful thing about starting with $100, you're not waiting for the perfect moment. You're not waiting for a raise. You're starting the clock right now. The goal isn't to get rich overnight. The goal is to let time do the heavy lifting. That's how investing with little money actually works. You're buying time in the market, and time is the one thing you can never get back. Before you throw that $100 anywhere, you need to understand where you're putting it, because the account type matters almost as much as what you invest in. There are basically 3 buckets to know about for beginner investing. First, your employer's 401k. If your job offers one and they match contributions, that is the single best place to start. A match is free money, 100% instant return on your investment. Put in enough to get the full match before you do anything else. Second, a Roth IRA. This is a retirement account where you invest after-tax dollars and your money grows completely tax-free. When you withdraw it in retirement, you pay 0 taxes. For most people just starting out, this is the sweet spot. You can open one with as little as $1 on most platforms, and you can contribute up to $7,000 per year in 2024. Third, a taxable brokerage account. This is just a regular investment account with no special tax treatment. No contribution limits, no restrictions on withdrawals. Great for goals that aren't retirement-related, like buying a house or building an emergency fund that actually works for you. If you're just starting out and you want to invest with little money, I'd recommend this order. Grab the 401k match first, then open a Roth IRA, then use a brokerage account for anything beyond that. Okay, so you've got your account. Now what do you actually put the money into? This is where most beginners freeze up, and it's totally understandable. There are thousands of stocks, ETFs, mutual funds, and crypto options screaming for your attention. Here's the honest truth. For most people, especially when you're just starting out, a simple low-cost index fund is the best answer. An index fund is basically a basket of stocks that tracks a market index, like the S&P 500, which represents the 500 largest companies in the United States. When you buy one share of an S&P 500 index fund, you're instantly diversified across companies like Apple, Amazon, Microsoft, Google, and hundreds more. You're not betting on one company. You're betting on the entire American economy. And historically, the S&P 500 has returned an average of about 10% per year over the long run. Two funds worth knowing about are VOO, which is Vanguard's S&P 500 ETF, and FZROX, which is Fidelity's zero-fee total market index fund. That last one is free to own. No expense ratio at all. If you want a little more diversification globally, throw in a total world index fund and you're covered. Don't overthink this. One or two simple index funds is a perfectly solid low minimum investment strategy that professional investors would respect. Real quick, if this is clicking for you and you want to keep building your investing knowledge, hit that subscribe button right now. Every week we put out content like this to help you build real wealth without the confusing finance speak. Now let's keep going. Now let's talk platforms. Because how to start investing is a lot easier when you have the right tools in your corner. Two apps stand out for people starting with small amounts. The first one is Acorns. Acorns is perfect if you're the kind of person who struggles to remember to invest consistently. It works by rounding up your everyday purchases to the nearest dollar and investing that spare change automatically. Buy a coffee for $3.50 and Acorns rounds it up to $4, investing that 50 cents for you. It sounds small, but those micro investments add up fast. You can also set up recurring deposits, and the app invests everything into a diversified portfolio based on your risk tolerance. It's genuinely one of the easiest entry points for beginner investing. The second platform worth knowing is M1 Finance. M1 Finance is a step up for people who want a little more control without it being overwhelming. You can build what they call a pie, basically a custom portfolio of stocks and ETFs, and M1 automatically rebalances it for you. There's no trading fees, and you can start with as little as $100 in a regular account or $500 for a retirement account. What I love about M1 Finance is that it bridges the gap between total autopilot and actually understanding what you're invested in. Both of these platforms make low minimum investments totally accessible and remove most of the friction that keeps people from starting. Here's a truth that doesn't get talked about enough in investing conversations. The habit matters more than the amount. $100 invested once is nice, but $100 invested every single month is a wealth-building machine. This concept is called dollar cost averaging, and it's powerful because it removes emotion from the equation. Instead of trying to time the market, buying when stocks are low and selling when they're high, which almost nobody actually does successfully, you just invest the same amount on the same schedule every month, no matter what. When prices are up, you buy fewer shares. When prices are down, you buy more. Over time, it averages out, and you end up paying a fair price without the stress of trying to predict the market. Set up an automatic transfer from your checking account to your investment account on payday. Even if it's $50, even if it's $25. The automation is everything. You won't miss money you never see sitting in your checking account. And 6 months from now, a year from now, 5 years from now, you'll look back and be genuinely shocked at what consistent, boring, automatic investing can do. That's the unsexy secret that actually works. Before we wrap up, let's talk about what not to do, because the investing space is full of traps that are specifically designed to catch beginners. First, avoid individual stock picking until you really know what you're doing. Buying $100 of one company's stock because you've heard about it on social media is not a strategy. It's gambling dressed up in a suit. Second, skip the crypto rabbit hole for now. Not because crypto has no place in a portfolio, but because volatility in crypto is extreme, and when you're just learning how to start investing, wild swings can scare you out of the market entirely. Build your foundation first. Third, watch out for high-fee products. Some actively managed mutual funds charge 1 to 2% per year in fees. That might sound small, but over decades, those fees quietly eat tens of thousands of dollars from your returns. Stick with low-cost index funds with expense ratios under 0.2%. And fourth, don't let perfect be the enemy of good. Waiting until you understand everything perfectly means you never start. You learn investing by doing it, not by reading about it for another 6 months. All right, let's pull this together. Starting to invest with $100 is not only possible, It's one of the smartest financial moves you can make, and the research is crystal clear that starting earlier beats starting bigger every single time. Here's your action plan. 1. Find out if your employer matches 401k contributions and capture every dollar of that match. 2. Open a Roth IRA or brokerage account on a platform like Acorns or M1 Finance today, not this weekend, today. 3. Buy a simple S&P 500 index fund and set up an automatic monthly contribution, even if it's small. 4. Ignore the noise. No stock tips, no crypto hype, no timing the market. Just keep buying and hold on. Investing with little money is not a limitation. It's a starting line. Every single wealthy investor started somewhere, and most of them wish they had started earlier. If this helped you, hit subscribe so you don't miss next week's video where we break down exactly how to build a beginner portfolio from scratch. The link is right there. Go watch it now.